My friends, what if I told you that everything you think you know about building wealth is designed to keep you poor? That the entire financial system, from the flashy headlines to the so-called hot tips, is engineered to trigger your most primitive fears and greed, making you a slave to market sentiment rather than a master of your own destiny? For decades, I've watched intelligent people chase financial freedom only to see it vanish in the next market crash. They pursue passive income but end up with passive losses. They seek the millionaire mindset but are trapped in a gambler's psychology. This is not investing. This is a sophisticated form of speculation, and it's the reason why 99% of investors never achieve true generational wealth. Today, I'm going to give you the antidote. We will dive into the 3 unbreakable laws of financial self-defense. This is not just a strategy, it's a shield. It will protect you from the emotional contagion of Wall Street and set you on the only proven path to long-term wealth and early retirement. Let's begin with the first law, the margin of safety. This is not just a calculation, it is your financial armor. In a world obsessed with get-rich-quick schemes and Bitcoin manias, the margin of safety is your anchor to reality. It's the simple, profound discipline of never overpaying. You must demand a discount, a buffer, between the price you pay and the true value you receive. Think of it as building a bridge designed to hold 20,000 tons when you only expect it to carry 10,000. That extra capacity is what allows you to sleep soundly when markets crash, turning panic into your greatest profit opportunity. The second law is Mr. Market. I want you to imagine the stock market not as a complex machine, but as a highly emotional business partner named Mr. Market. Every day he shows up at your office door offering to either buy your share of the business or sell you his. Some days he is euphoric and offers you ridiculous inflated prices. Other days he is deeply depressed and willing to sell you his share for pennies on the dollar. Your job is not to react to his mood swings. Your job is to be the Lengjing psychologist who takes advantage of his manic depression. When he is greedy, you sell. When he is fearful, you buy. This is the core of value investing and the key to building wealth against the crowd. The third law, the one that truly unlocks explosive growth, is intellectual self-reliance. You must stop outsourcing your financial decisions. The search for a white knight, a guru, a newsletter, an algorithm is the most dangerous trap. Financial independence does not start with a stock tip. It starts with the courage to do your own homework. You must become the expert on your own money. This is how you build a wealth creation engine that no one can take from you. Now you might be thinking, Benjamin, this sounds great, but how do I actually calculate this margin of safety for a modern tech stock? Or how do I find these cigar-butt stocks trading for less than their cash value in today's market? This is exactly what we will master in the rest of this masterclass. I will show you my step-by-step stock screening process for finding undervalued stocks, how to analyze a balance sheet to avoid value traps, and how to structure your portfolio for maximum compound interest with minimal risk. If you're ready to stop following the herd and start building a fortune based on unshakable principles, then you need to see this through. The rest of this video will change how you see every investment decision for the rest of your life. So, make sure you are subscribed, and let's continue this journey to financial mastery together. Now let's get practical. I'm going to give you the exact framework I used to consistently beat the market for decades, what I call the 3 pillars of intelligent investing. This isn't theory. This is the same system that helped create some of the greatest fortunes in Wall Street history. The first pillar is quantitative analysis. You must become a detective of numbers. When I analyze any company, I start with 3 non-negotiable calculations. First, the net current asset value. Is the company trading for less than its liquidation value? Second, the earnings power value. What would a rational business person pay for this company's profit-generating capability? Third, the discount rate. Am I being properly compensated for the risk I'm taking? These calculations form your margin of safety in mathematical terms. Let me give you a modern example. Imagine a technology company that's fallen out of favor. The headlines are negative, the stock price has dropped 50%, and everyone's panicking. The intelligent investor doesn't see danger, they see opportunity. They calculate that even if the company's growth slows dramatically, it's still trading at 60 cents on the dollar relative to its intrinsic value. That 40% discount is their margin of safety. That's the mathematical edge that creates generational wealth. The second pillar is qualitative assessment. While numbers don't lie, they don't tell the whole story. You must ask crucial questions about the business itself. Does it have a durable competitive advantage? Is management competent and shareholder-friendly? Is the industry facing structural decline or temporary challenges? I learned this lesson painfully during the railroad boom of the 1920s. The numbers looked spectacular, but I failed to see how automobiles and trucks would revolutionize transportation. Never fall in love with numbers to the point where you ignore reality. The third pillar, and this is the most overlooked, is psychological preparation. You can have the perfect quantitative analysis and flawless qualitative assessment, but if you lack the emotional discipline to hold through market volatility, you'll still fail. This is where most investors self-destruct. They buy a wonderful business at a great price, then panic sell during the inevitable temporary decline. The difference between successful investors and the perpetual losers isn't intelligence, it's emotional fortitude. Here's my simple but powerful exercise for developing this fortitude. Before you buy any investment, write down 3 specific conditions under which you would sell, not based on price movements, but based on fundamental changes in the business. If the competitive advantage erodes, sell. If management becomes dishonest, sell. If the intrinsic value calculation was fundamentally wrong, sell. But never sell because Mr. Market is having a bad day. In our next segment, I'll show you how to apply this 3-pillar framework to modern markets, including technology stocks, cryptocurrencies, and international investments. But first, I want you to take this framework and apply it to one company in your watch list right now. Do the quantitative calculations, assess the qualitative factors, and most importantly, prepare yourself psychologically for the volatility ahead. Remember what I taught my students at Columbia. The investor's chief problem, and even his worst enemy, is likely to be himself. This framework is your defense against that enemy. My friends, we now arrive at the most crucial adaptation of all: how to apply these timeless principles to today's revolutionary markets. Many of you have asked, Professor Graham, how do we calculate intrinsic value for companies that don't have factories or inventory? How does margin of safety apply to businesses built on algorithms and network effects? These are excellent questions that demand thoughtful answers, and that's exactly what we'll explore right now. The fundamental truth remains unchanged. Every business, whether it produces steel or software, has an intrinsic value based on the present value of its future cash flows. The methodology, however, must evolve. When analyzing technology companies, you must expand your definition of assets to include what I call the 4 modern moats. First, network effects. Does the product become more valuable as more people use it? Second, intellectual property. Does the company own protected technology or patents? Third, data assets. Does it possess unique information that creates competitive advantages? Fourth, ecosystem lock-in. Do customers become increasingly dependent on the platform? Let me give you a concrete example. Consider a cloud computing company. Traditional metrics might show it trading at 50 times earnings, seeming dangerously overvalued. But the intelligent investor looks deeper. They analyze the recurring revenue streams, the customer retention rates, the total addressable market, and the scalability of the business model. They might calculate that based on projected free cash flows 5 years from now, the company is actually trading at a significant discount to its future intrinsic value. This forward-looking margin of safety is how value investing evolves without abandoning its core principles. Now, let's address the elephant in the room: cryptocurrencies and digital assets. Here, you must apply even more rigorous thinking. Ask yourself, does this asset generate cash flow? Does it have utility beyond speculation? Is there a measurable intrinsic value, or is it purely dependent on greater fool theory? I cannot give you a simple formula for valuing Bitcoin, but I can give you a framework for thinking about it. Treat it as you would any highly speculative investment. Limit your exposure to what you can afford to lose. Demand an enormous margin of safety in your purchase price, and never confuse speculation with investment. But here's what most investors miss about modern markets. The psychological challenges have multiplied exponentially. In my day, you might read the newspaper once and check stock prices weekly. Today, you're bombarded with thousands of data points, opinions, and price movements every hour. This creates what I call analysis paralysis, the inability to make decisions because of information overload. The solution isn't more information, it's better filters. You must create what I call an information filtration system, ignoring 99% of market noise and focusing only on the fundamental data that truly matters. Let me share a personal story about adaptation. When I began teaching in the 1920s, I focused almost exclusively on statistical bargains, companies trading below their net current assets. But as markets evolved, I recognized the need to also study growth companies selling at reasonable prices relative to their future earnings power. This wasn't abandoning value investing, it was expanding its application. The same evolution is required today. Your action plan for modern markets should include these key adaptations. First, expand your valuation toolkit to include metrics relevant to digital businesses, customer acquisition cost, lifetime value, and network effect strength. Second, adjust your margin of safety requirements based on business model stability, demanding larger discounts for more speculative ventures. Third, maintain what I call a core and explore portfolio structure, keeping the majority in proven value investments while allocating a small portion to experimental opportunities. In our final segment, I'll give you my complete checklist for surviving and thriving in the coming decade, including specific companies that represent modern value opportunities and the psychological tools you'll need to navigate the increased volatility ahead. But for now, I want you to begin this mental transition. Start analyzing one modern company using both traditional value metrics and these new frameworks. The future belongs to investors who understand both the timeless principles of value and their modern applications. Remember, Mr. Market hasn't changed, he's just gotten faster and louder. Your job isn't to keep up with his speed, but to maintain your discipline despite it. The principles we've discussed today are your anchor in increasingly turbulent waters. Hold them close, apply them wisely, and continue your journey toward becoming the intelligent investor you were meant to be. My friends, we arrive now at our final lesson, the master framework that will not only protect your capital in the coming years, but position you to build extraordinary wealth, regardless of what Mr. Market decides to do next. What I'm about to share represents the culmination of 60 years of research, observation, and practical application in every type of market environment imaginable. Let's begin with what I call the permanent portfolio architecture. This isn't about picking stocks. It's about designing a wealth-building machine that works in bull markets, bear markets, and everything in between. The architecture rests on three pillars. First, a foundation of unshakable value investments. Companies so fundamentally sound and so cheap that they're virtually immune to permanent loss. Second, a growth layer of adaptable compounders. Businesses riding powerful secular trends, but purchased only at reasonable prices. Third, a protective sleeve of crisis assets, investments that tend to perform well precisely when everything else is collapsing. Now let me show you how this works in practice. Imagine we're facing a period of high inflation similar to the 1970s. Your value investments provide the anchor. Companies trading below their net current assets actually benefit as their inventory and receivables become more valuable. Your growth compounders, if chosen wisely for pricing power, can raise prices along with inflation. And your crisis assets, whether it's certain commodities, treasury bonds, or other inflation hedges, protect your purchasing power. This three-layer approach creates what I call all-weather wealth. But here's the element most investors completely ignore: the psychology of crisis management. I've lived through more market crashes than most people have seen in their entire lifetimes: 1929, 1937, 1973, 1987. Each time the pattern was identical: initial disbelief, then panic, then capitulation. The investors who not only survived but thrived were those who had prepared their minds years in advance. They'd written down their crisis playbook during calm markets. They knew exactly what they'd buy, when they'd buy it, and how much they'd allocate long before the storm hit. Let me give you my personal crisis checklist, the same one I used during the 1973 to 74 bear market. First, when quality companies hit my predetermined crisis prices, typically 50 to 60% below their recent highs, I become an aggressive buyer. Second, I maintain a crisis war chest of at least 25% cash during normal times, specifically for these rare opportunities. Third, I focus exclusively on businesses with fortress balance sheets, companies that can survive years of losses if necessary. Fourth, I completely ignore macroeconomic predictions and focus solely on price-to-value discrepancies. Now let's project these principles forward to your world. What crises might you face? Technological disruption, currency debasement, geopolitical conflicts. The specific threats may differ, but the human psychology remains identical. Your preparation must therefore focus on developing what I call crisis immunity, the ability to not just withstand market collapses, but to embrace them as opportunities. Here's your action plan for the next decade. First, build your permanent portfolio with the three-layer architecture we discussed. Second, create your personal crisis playbook today. What will you buy if the market drops 30%? 40%, 50%. Third, develop your psychological resilience through what I call volatility exposure therapy, deliberately exposing yourself to small amounts of market turbulence to build emotional immunity. I want to leave you with one final thought from my experience. The greatest investors I've known, and I've known many of the legends, shared one common trait. They loved bear markets more than bull markets. They understood that bull markets make you feel rich, but bear markets make you actually rich. They recognized that the true money is made not in the buying or the selling, but in the waiting, the patient, disciplined waiting for the perfect pitch. You now have everything you need: the principles, the frameworks, the psychological tools. The rest comes down to courage and discipline. Will you have the courage to buy when others are panicking, the discipline to hold when others are greedy, the wisdom to know the difference between price and value? Remember these lessons, internalize these frameworks, and go forth not as a speculator hoping for luck, but as an intelligent investor building your destiny, one rational decision at a time. This is Benjamin Graham, signing off with one final piece of wisdom. The market is there to serve you, not to instruct you. Never forget who works for whom.